Billions of dollars. That's the staggering valuation now attached to securing cutting-edge AI compute infrastructure, drawing in major data center operators globally. Industry giants, once focused on different revenue streams, are making strategic pivots, recognizing the seismic shift underway. This isn't just about incremental growth, it's a wholesale reevaluation of digital real estate. What's driving this monumental change right now is an insatiable, exponential demand for processing power, fueled by generative AI. It's pushing every facet of the tech landscape to its absolute limit, transforming business models overnight. We're witnessing a gold rush for silicon, where access to high-performance GPUs dictates future market leadership. This isn't just a trend, it's the fundamental re-architecture of the digital economy. Major hyperscale data center operators, the backbone of the internet, are at the forefront of this transformation. For years, many leveraged their vast energy capacity and infrastructure for Bitcoin mining, a lucrative but volatile venture. Now those same facilities, once humming with specialized crypto hardware, are being retrofitted at an incredible pace. The shift is monumental, driven by the escalating computational needs of advanced AI models. Think about it. Training a single large language model can require compute resources equivalent to millions of CPU hours. This demand is creating an unprecedented market for specialized AI-ready infrastructure, prompting a massive reallocation of capital and expertise towards high-density GPU clusters. It's a strategic move, positioning these companies at the heart of the next technological frontier. Industry analysts, including those at leading firms like Gartner and McKinsey, consistently highlight the explosive growth in AI infrastructure spending. Recent projections suggest the global AI market, specifically for compute, could reach several $100 billion within the next few years. This dwarfs previous forecasts for crypto mining infrastructure. We're seeing reports from financial powerhouses like Bloomberg and Reuters detailing the dramatic repurposing of mining sites. Power grids, once stressed by energy-intensive crypto operations, are now being evaluated for their capacity to support high-density AI clusters. Major tech firms are vying for access, with some even pre-booking capacity years in advance. This fierce competition underscores the scarcity of suitable, ready-to-deploy infrastructure for AI workloads. Here's what nobody mentions about this pivot. Retrofitting a former Bitcoin mining farm for cutting-edge AI isn't simply a plug-and-play operation. It's an engineering nightmare, demanding a complete overhaul of power distribution, cooling systems, and network architecture. Bitcoin miners run hot, sure, but AI GPUs, especially in dense clusters, generate localized heat spikes that require entirely different liquid cooling solutions. The power demands shift from brute force consistency to highly variable, high-peak loads. Companies aren't just swapping out chips, they're rebuilding the fundamental physics of their data centers. This intricate process requires specialized expertise, sophisticated hardware, and significant capital investment, often far exceeding initial estimates. For instance, a recent study by Greenidge Generation Holdings, a leading cryptocurrency miner, found that retrofitting their 100-megawatt facility in New York to support AI workloads increased their power costs by over 300%, while also requiring a 40% increase in cooling capacity. Moreover, the same study revealed that the facility's AI workloads generated 20% more heat per megawatt of compute power compared to their traditional Bitcoin mining operations. In another example, Hive Blockchain Technologies, a Canadian mining firm, reported that their AI-focused data center in Sweden required a complete overhaul of their electrical infrastructure, including the installation of high-voltage switchgear and transformer upgrades, at a cost of over $10 million. Deals crossing the billion-dollar threshold for AI compute capacity are becoming increasingly common, a testament to this strategic realignment. Major cloud providers and AI developers are locking in multi-year agreements, sometimes for entire data center campuses. Reports from the Wall Street Journal and reputable tech publications indicate a significant uptick in these long-term contracts. These aren't just small-scale partnerships, they represent massive commitments, securing hundreds of thousands of next-generation GPUs. The sheer scale of these agreements reflects the belief that AI will be the primary driver of technological advancement for the foreseeable future. This aggressive contracting highlights the urgency and the high stakes involved in the global AI race. The trend is exemplified by Hyperscale Data's recent $1.2 billion AI compute deal, which solidifies its position as a leader in the field. Notably, this agreement is the largest of its kind, surpassing previous records set by industry giants such as Google Cloud and Microsoft Azure. According to a report by MarketWatch, AI compute capacity is projected to grow by 50% annually over the next 5 years, fueled by the increasing adoption of AI technologies in industries such as healthcare, finance, and transportation. Furthermore, a study by Deloitte found that companies investing in AI are seeing an average return on investment of 300%, underscoring the strategic importance of these long-term contracts. Many assume the shift from Bitcoin mining to AI compute automatically solves the environmental concerns surrounding energy consumption. Here's the uncomfortable truth. It doesn't necessarily make data centers greener overnight. While Bitcoin mining has faced scrutiny for its energy footprint and often reliance on fossil fuels, AI workloads, particularly during model training, are incredibly power-hungry too. The difference often lies in how that energy is sourced and how efficiently it's utilized. Hyperscalers are now investing heavily in renewable energy solutions and advanced cooling techniques, not just for PR, but out of sheer necessity to manage costs and sustain operations for these even more intensive AI tasks. It's a different kind of energy challenge, not an absence of one. For instance, Google's data center in Hamina, Finland, has been powered entirely by renewable energy since 2020, showcasing a possible path forward. Similarly, Microsoft has set a goal to power 60% of its data centers with renewable energy by 2025. According to a report by the International Energy Agency, AI alone could account for up to 14% of global electricity demand by 2030, highlighting the pressing need for sustainable solutions in the AI compute space. Forget Silicon Valley as the sole hub for this AI revolution. The critical factor for these massive AI compute deals isn't just talent or venture capital, it's access to cheap, abundant, and preferably renewable electricity, coupled with robust fiber optic networks. This drives the expansion into unexpected geographies: former industrial zones, rural areas near hydroelectric dams, or regions with strong wind and solar infrastructure. Local governments are actively courting these projects, offering incentives and fast-tracking permits, recognizing the economic boom they bring. It's creating new tech epicenters far from traditional hubs, decentralizing the digital infrastructure in ways few predicted. For instance, the state of Georgia in the United States has emerged as a significant player in the AI compute market, thanks in part to its favorable business climate and access to cheap hydroelectric power from the Tennessee Valley Authority. Google's $1 billion data center in Lenoir, North Carolina, is another example of how the Southeast is becoming a hotspot for AI compute infrastructure. In fact, according to a report by the University of North Carolina's Keenan-Flagler Business School, the state of North Carolina alone is expected to see a $1.6 billion economic impact from data centers by 2025, with thousands of new jobs created in the process. The ripple effects of this AI compute gold rush are felt across the entire semiconductor supply chain. Leading chip manufacturers are reporting unprecedented order backlogs for high-performance GPUs, stretching well into the next fiscal year. Financial news outlets like CNBC and Bloomberg frequently cover the bidding wars for manufacturing capacity. This isn't just about consumer electronics. It's about the foundational building blocks of the AI era. Foundries are struggling to keep up, leading to extended lead times and significant price premiums for specialized AI accelerators. The scarcity is real, pushing innovation in chip design and advanced packaging technologies to new heights, all to meet the insatiable demand. According to reports from the Semiconductor Industry Association, AI-related chip sales have surged by 20% in the past quarter, with NVIDIA's A100 GPU sales alone reaching $1.5 billion in revenue. Meanwhile, Taiwan Semiconductor Manufacturing Company, TSMC, has reported a 15% increase in its wafer production capacity, specifically for high-performance computing applications. Companies like Google and Amazon have been investing heavily in custom chip design to meet their AI compute needs, with Google's Tensor Processing Unit, TPU, being a prime example of this trend. As a result, the global AI chip market is projected to reach $20.4 billion by 2025, up from $4.6 billion in 2020, according to a recent report by Markets and Markets. Here's a critical, often overlooked aspect of this hyperscale AI expansion: the immense cybersecurity challenge it presents. Concentrating vast amounts of proprietary AI models, training data, and intellectual property within these super-dense compute clusters creates incredibly attractive targets for nation-state actors and sophisticated cybercriminals. The stakes are astronomically high. Protecting these digital fortresses requires an entirely new level of security architecture, from physical safeguards to advanced threat detection using AI itself. A breach here wouldn't just mean data loss, it could compromise the very algorithms driving critical national infrastructure, financial systems, or even defense. It's a digital arms race playing out in the shadows. Take, for instance, the 2022 breach at NVIDIA's data center, which exposed sensitive information about their AI chip designs and development. Or the 2020 attack on the Singaporean government's AI-powered surveillance system, which was crippled by a sophisticated malware campaign. According to a report by Cybersecurity Ventures, the global AI cybersecurity market is projected to reach $15.7 billion by 2025, with a compound annual growth rate of 28.5%. Many perceive AI as purely a software game or a chip battle. Yet, the real unsung heroes facilitating this revolution are the hyperscale operators and their engineering teams, meticulously building and optimizing this physical infrastructure. They're not just providing servers, they're creating the very bedrock upon which future AI breakthroughs will be built, transforming former crypto mines into AI powerhouses. This isn't just a pivot, it's a fundamental re-engineering that democratizes access to compute, making advanced AI capabilities available to a broader range of innovators. The shift from Bitcoin mining to AI compute is more than a business decision. It's a foundational change. Stay tuned to see how this redefines our technological future, and hit that subscribe button to keep up with the next big shifts. Wall Street is buzzing. Leading economists from institutions like the IMF and the Federal Reserve are weighing in on the implications of this compute arms race, highlighting its profound impact on global financial stability and growth trajectories. They're quick to point out that the sheer scale of investment in AI is fundamentally reshaping capital markets, moving beyond traditional tech valuations and creating entirely new asset classes. What we're seeing isn't just a sector boom. It's a rapid recalibration of global economic priorities, with nations and corporations scrambling for a piece of the pie. Analysts at prominent financial firms, many cited in recent Bloomberg reports, now regularly forecast how compute scarcity could affect GDP growth in advanced economies, drawing parallels to past industrial revolutions. There's a strong consensus emerging. Access to advanced AI compute is quickly becoming a new metric of national power, a critical determinant for economic competitiveness in the coming decades. This isn't just about big tech firms making big profits. It's about the entire economic fabric getting a radical, high-speed upgrade. Countries worldwide are feeling the pressure, recognizing the strategic imperative of securing their own AI capabilities. European Union leaders, for example, are pushing for stronger regional data center capacity and indigenous chip development initiatives to reduce reliance on external providers. Across Asia, governments are pouring vast sums into national AI strategies, aiming to attract major compute projects with lucrative incentives and streamlined regulatory processes. We're seeing a geopolitical scramble, a race to establish national sovereignty over data and algorithms, shaping future trade agreements and international partnerships. This fierce competition for compute resources is creating new trade routes and diplomatic channels, redefining global power dynamics. Nations understand, falling behind in this AI race means risking economic relevance and strategic influence, for generations.